Hi guys, we're going to go through these results and then I'm going to go through some other opinions from Simply Wall Street. I'm going to look at the shares and I'll give my opinion at the end. Oh, sorry. Presenting team. So this is Richard, the CEO, and Andy, the CFO. You've got the structure here. I'm going to whiz through this. It's not going to be too long. I want to get to the meaty stuff, no pun intended. Founded in 2007, brought over from San Francisco, listed in 2021 when I invested. Leading fast casual Mexican restaurant, 68 sites worldwide, 23 outside the M25. Value for money, it's low cost and it's great food. Strong track record of financial performance. They've got central kitchens and they ship the food out if you like. And they've got amazing future opportunities, which they'll go into. 64 stores up until the end of the period. They've added more stores since. They've got new delivery kitchens, which are amazing, and they're partnering with Merlin Entertainments to open at Chessington World, which is like the leisure world. That could open up a range of other opportunities with Alton Towers, with SeaWorld, with other tourist type destinations. Expansion of existing partnerships in airports, and they've got a strong pipeline of 45 sites over the next 5 years. I think they'll smash that. I think they'll get over 100 sites in the next 5 years. We'll talk about that later in this presentation, why I believe that. Revenue's up 80% despite COVID. Like-for-like revenues is a measure of how good the stores are doing organically, up 23% versus 2019 before COVID. Adjusted EBITDA up 262% to 8.7 million. Strong balance sheet, net cash of 6 million. It's very cash generative, and they've got a refreshed capital structure which is supporting future growth. So I think this is amazing. 262 up, adjusted EBITDA. That's incredible results here. Revenue up 80%. Let's dig into this with the financial review. Like for likes, blah blah blah. Gross profit margin 80%, which is a bit like software as a service, to be honest. It's not really typical for restaurants to have a gross margin of 80%. They've got some administrative expenses. Still, they're doing very well. Profit before tax 3.3. With this new structure, profit before tax was 1.4. But I wanted to kind of dig into this. Basically, they've got they've got increased admin expenses, but I don't think that's going to continue year on year to go up and up. I think it will go up, but I don't know if it'll go up by 50% a year. There's something else I wanted to point out. I think it's in the balance sheet slide that's coming up. So I have I looked at this just before. You can see the general trend that the mix of sales, delivery, takeaway, and eat-in is really strongly balanced. And overall, it's doing very, very well. 8.7 million adjusted EBITDA, a record year. We've got about 2 million from the government, so 6 to 6.5. Healthy spread of strong profits across the UK, giving expansion confidence. And their like-for-like sales is much above the industry standard. This shows you what a strong company they are. Now, here we go, the balance sheet. You can see here that total assets 46. Where was it? Trade payables, fine, that's gone up. Leasing is a kind of cost of doing business, but loans, look at this. 2021 they had 11 million loans. 2022 they only had 2.9. So with that differential for next year, they could have a lot more revenue next year if they paid off, circa 8.5 million in loans in this year. That means, that could get added to the bottom line, if you like. So I wouldn't be surprised if earnings went up substantially next year. That's just something I picked out and found here. If you've got any comments or questions, let me know, of course, in the comment section below. This is how they're conquering these challenges or managing these risks. Labor's obviously a risk, but they've already increased their wages, and they haven't had to shut any stores due to staffing issues. They have simple menu, which means not a lot of training, and they don't need highly skilled workers, and they don't need highly skilled chefs because the things are basically cooked off-site mostly, and they're produced in a very easy, simple way. And not a lot of antisocial working hours. So if you're kind of 18 and you want to work in a pub, this might be better and more sociable than working in a pub. Utilities, they're kind of locked in rates and they're managing inflation as well. They're good value compared to the competitors. Just a note, actually, since this presentation was produced, they've actually acquired Chilango for about 2.5 million. So they're actually a bigger group now. But anyway, basically what's important to customers is good value. They are one of the lowest priced in the market. They're much better than Taco Bell, which is basically awful food. Leon's quite nice, but it's not as kind of filling as a Tortilla. And I know this sector very well. I know all these brands. Honest is a burger chain. Wagamama's is kind of Chinese, Japanese. Pho's Vietnamese. Five Guys is crappy American food. Nando's is faux Portuguese chicken food. But if you're a vegan or a vegetarian, then Tortilla is very good. Plus, I think it's the best Mexican on this place, better than Chipotle, better than Chilango and Taco Bell. And as people, as they're saying here, as people kind of tighten their belts because of cost of living crisis, they may flow over to Tortilla. They may want to shop at Tortilla more. And then this survey is based on 3,300 Tortilla customers. What 5 factors would you most associate with Tortilla? They're saying that value is one of them, and they're saying that the taste is good. So when you compare that, people want to save money, they want good taste, they're going to go to Tortilla, right? From the CEO, like for like, 20%, amazing. 2022 started well. A lot of confidence in this 45 store openings. They've already opened in these cities. Interestingly, that it's mirrored with some of the other startups that I invest in. Escape Hunt or XP Leisure, they're opening stores in similar places, maybe because of the high university campuses, potentially. Launch of franchise partnerships with Compass Group, and this is talking about universities. They want to open 10 over the next 5 years. I would think that because if they see good results, they could probably open more than 10 because it's not based on Tortilla's resources. It's based on Compass Groups. So if they see they're getting a good, strong return from those stores, they may open more than 10. They may open 12. They may open 15. They may open 20 over the next 5 years. Why not? Delivery kitchens, we'll talk about that in a minute as well. Trading environment is rough, but Tortilla is doing very, very well compared to the competition. If you look at the restaurants, they're well above it. That's because they've got an amazing brand. They've also got favorable property. Market is okay for them. They have acquisition growth opportunities, and they're managing costs, and they can grow outside the M25, which is basically London. They've got the accelerated UK rollout. Franchising is amazing. Delivery kitchen is amazing. So is international growth. I see a lot of Arabs and Middle Eastern people when they go. When I go to Stratford, which is in East London, there's a lot of mix of different nationalities that like Tortilla. It is universal. So 3 stores opened in during the final year 21 at Edinburgh, Windsor, and Exeter. So this is showing that there's so much scale or scope for scale in the UK. I don't think they have any stores in Hertfordshire, where I currently live. I don't think they have many in East London and Essex outside of Stratford. There's loads of places that they could have stores. I wouldn't be surprised if the UK would actually support 500 stores. I know the management's never going to say that, but I think it probably could support 500, maybe even 1,000. I'll tell you why I believe that later on in the video. The airport stores do very well. I had some food at Gatwick Airport. It was great. And it's what you want. You want something substantial before you go on a flight that's not going to mess up your stomach. It's going to be low cost. Tortilla is the place to go. Education campuses with Compass, Merlin Entertainment. So they've got like leisure, they've got travel with the airports, and they've got education with the universities. And they're looking at other opportunities. Why not military bases? Why not inside of office buildings? A very large office building. Meta, we have hundreds of people working in Meta. Why don't they try and partner with a big corporate? There's going to be loads of opportunities, of course, loads. Delivery kitchens, look at this. The airports average 50k a week revenue, but they're saying with delivery, it's low capex, meaning they only need 10k to make the sites profitable. Now, I've invested in Domino's Pizza, and they talk about a 1 mile radius around their delivery stores. That means that Tortilla could have literally hundreds, if not thousands, of stores in the UK alone. Why? Because they don't need that many houses for a 1 mile radius. And if you think about city centres, there's lots of apartment buildings where you have a high density of people that might, students, young professionals, families that might want to order more than once a week. They might order twice a week or 3 times a week. International is obviously huge as well. This could easily be in the Middle East. It already is. There's a lot of appeal there. Obviously, there's a natural expansion into Europe. The US, where burritos are massive, it could easily go global. That's why I believe they can have a lot more stores than 45 in 5 years. If you think about, let's just go back to this partnership with Merlin, you could easily get like 5-10 stores from that. Airports, you could easily get 10 airport stores easy in the UK alone. And educations and campuses, colleges and universities, you could probably get 50 there. So you got like 75, I'd say, just from that 3. And there's other opportunities, of course, as well. Maybe in cinemas or something, for example. So they've got record financial results. It's a strong brand, of course. It's well positioned to navigate uncertainty because they're managing the risks. They benefit from flexible and property dynamics. They're looking forward with confidence, and they remain very confident. I'm just going to have a quick look at the what Simply Wall Street make of this. So I'm going to go to the top. What do they make of it? They say it's 32% below what they think is fair value. They think that revenue's grown 18%, even though it's grown a lot more than that. They say it's gone profitable this year. They're comparing it across a few others. Fulham Shaw, which I actually invest in there, in Franco Manca and the Real Greek. Daniel Thwaites, I haven't heard of. Brighton Pier, I haven't heard of either. Or Heavy Tree Brewery. Maybe I could look at these, of course. But overall, the value is there. Health is there. The past is there. But I think they will have dividends in the future. I'm surprised they're not rating it with a high future value. Not quite sure. Let's dive into that. So obviously the share price has collapsed for no reason. I really have no idea why it's collapsed. They bought Chilango for 2.7 million. It's debt-free and cash-free basis. So let's just have a quick look at that. Yeah, majority of the transaction is using loans. So they've basically got another brand for like very little. And Chilango got 7 million in revenue, and it was slight loss making. But if they convert them into tortilla restaurants, which have a higher return on investment, then they could do very well. So expected to produce 0.1 million to the group for the remainder of financial year 2022, and then 1 million a year after that. So if they bought it for 2 million and they're getting 1 million a year, that's like 33% return on investment, like straight off the bat. And they're doing it from loans as well. So, they probably are not putting up capital for this. So the return on investment is huge. I think that is a fantastic purchase. And I'm sure they'll be buying other chains and other mom and pop stores as well going forward. So I don't know why they haven't factored that in, to be honest, because that's pretty big. If you put a 20x multiple on that, that should add 20 million to the market cap. The market cap's only 50 million at the moment. So I think it's already in value just on that Chipotle, Chilango acquisition. What else we got? Yeah, so I think it's the earnings is they're saying it's 1.36 million here, but we know it's going to be at least 2.3 next year. And of course, with the fact that they're not paying off debts, then or not paying off as much debts in the years to come, that earnings could easily bloat to 5 or 6 million. And if it stays at 36x from a PE ratio perspective, that would be quite a large valuation, wouldn't it? So if they earn, let's say like in 3 or 4 years, it goes up to 10 million in earnings, which I think it probably could, then it would be valued at 360 million, which would be quite a good return. What's that? About 7x return. And of course, we're not even factoring in, international and other things there. So I do think this is a very good, stock. That's my opinion. Fulham Shaw has a very high PE ratio, but I think they will become profitable and do very well. Fulham Shaw, they were hit particularly bad by lockdowns. I don't think they do delivery nearly as well as Tortilla. Anywho, yeah, versus the industry, the industry is less, but I think that Tortilla has very, very high earnings potential. Domino's Pizza is one of the first companies I invested in. It's got a price to earnings ratio of 13, estimated growth of 2%. Tortilla has an estimated growth of, well, no one's put it in. It's such a small start, people don't cover it. But I like to uncover some of this value. I think it's really important. They think that it's a fair PE. I think it's a fair PE. I mean, I think it's undervalued, to be honest. Yeah, so they think it's about 30% increase undervalued. But I think it's more than that. I think it's worth at least 100 million. And it's only at 49 million at the moment. 18.5% expected annual revenue growth when they boosted it 80% recently. I think it's going to be 10% return on equity. I think it's going to be much higher than that. If you think about delivery kitchens, that could easily be over 30%. I think a lot of their other stores have around 30 to 35%, and they've said this in the AGM. I think they target 30%. So it's going to be, I think, at least double this 10%, probably triple, maybe even higher than that when franchising comes in, when international growth comes in, when delivery kitchen comes in. If they start to ramp prices a little bit because they've fixed a lot of their costs and hedged, I think the return on equity or return on cash could be a lot higher than 10%. Historic annual earnings growth of 43%. It's grown much higher than that recently. Okay, I'm going to stop sharing my screen now. I hope that's been helpful. What's my opinion on this? I think this is one of the hottest stocks in the UK. I can't believe it's only valued at 49 million. I can't believe the stock price has decreased, to be honest, as the company has done so well. But sometimes pricing is irrational in the stock market, and you have to invest when others are being fearful. I'm an investor in a company. I wish I had a bit more funds to invest more in these companies. When more funds become available, I'm getting married in 5 weeks from now. Well, you can't see my hand very well there, but 5 weeks. So I don't have a lot of free capital to invest, but I do think it is a very, very strong proposition. I wouldn't be surprised if the company had hundreds of stores in the next 5 years. They're saying they're going to build 45 from 68, so just over 100. I think could be easily 200 in the next 5 years, and then from there they're only going to grow and grow. Dividends will come, I expect, as they're going to be highly cash generative, and I just think it's fantastic business. So I don't really have anything else to say, but if you're an investor in Tortilla, let me know. If you're considering investing, let me know. If you've got any questions or comments or queries for me, then of course put it in the comments section below. If you work for Tortilla, whether you're working in one of the stores or if you're working for the management committee, I'd love to know what you think about my analysis. Let me know in the comment section below. If you like investing, you want to learn more about investing in listed equities, I've got tons of videos about that, including some from 8-9 years ago, believe it or not, as well as investing in digital angel investing, which is investing in smaller companies with potential higher growth rates, but also higher bankruptcy rates as well, so slightly higher risk. But I've got loads of videos on that where I do similar analysis of kind of potentially high growth companies, so check that out. Also, I've got other videos on property investment, on Airbnb. I'm going to probably venture a little bit into crypto, but my core is always going to be shares, investing, and property. Hope you enjoy these videos. If you do, the best way you could help me would be to like the video and subscribe. Probably in the future, I'm going to open up a community, maybe on Discord. So there might be opportunity to join that in the links section below. Love to hear from you. Knowledge is power, especially the right kind of knowledge. And progress is everything. I'll see you guys in the next upcoming video. Take care.